Welcome to the deep dive. If the closing months of 2025 felt like riding a Bronco, unpredictable, fast, and forcing you to hold on tight, you are definitely not alone.
Not at all.
We are at a true inflection point in global finance, and it's driven by this powerful confluence of central bank policies pulling in opposite directions, persistent geopolitical pressure, and of course, the furious, frantic pursuit of the great AI boom.
That's the perfect description. For this deep dive, we've synthesized a stack of your sources, the forecast, the analysis, the major economic data from the end of 2025 and looking into 2026.
And our mission?
Our mission is to move beyond the headlines and really extract the common threads, the critical data points across global monetary policy, that stunning market divergence we're seeing, and the new regulatory frameworks for digital assets and AI.
So you walk away with the big picture.
Exactly.
Okay, let's unpack this. We've organized this around three big pillars that are really reshaping the year ahead. First, the central bank crossroads.
Where Japan is doing one thing and the Fed is doing something else entirely.
A whole other drama. Then we'll dive into the great commodity divergence, metals versus energy.
Soaring highs and real softness side by side.
And finally, we'll connect the dots between the global regulatory surge hitting crypto and the dangerously speculative debt that's fueling this whole AI infrastructure boom.
Let's start with monetary policy because the divergence is, it's truly startling.
How so?
They've been cutting rates through 2025 to deal with cooling inflation.
Japan was the big exception.
The major exception. The Bank of Japan, the BOJ, they actually raised their policy rate in December, hit a 30-year high.
A 30-year high. That sounds dramatic. But in context, how big a move is this, really?
It's historically significant for Japan, for sure, but it's still a very, very gentle tap on the brakes.
Okay.
The key rationale, according to Governor Ueda, is that Japan is steadily approaching that 2% inflation target they've wanted for decades.
And what makes them think this time is different?
It's what they're calling that critical virtuous cycle. They feel like it's finally taking hold.
And what does that virtuous cycle actually look like on the ground in Japan?
It's the idea that wages and prices are rising together, sustainably.
Oh, okay.
So in the past, Japanese inflation was often just, imported costs, energy, food.
Right.
Now the BOJ sees price rises across a much wider range of goods and services, and that's their proof that wage increases are actually driving domestic demand. It's the first time in a generation they feel it's real.
So even with this historic hike, what's their immediate stance? Are they signaling more aggressive tightening?
Not at all. What's crucial to understand is that even after this hike, real interest rates, so the rate adjusted for inflation, they remain significantly low.
So policy is still very loose.
Highly accommodative. Analysts describe it as taking their foot off the accelerator rather than stepping on the brake. They're just trying to manage a very delicate exit from decades of zero rates.
So what does the future path look like then? Are we expecting a flurry of hikes in 2026?
Further rate increases are expected, yes, but the next likely hike is signaled to be post-June 2026.
Why so far out?
They're being very clear they need to wait for more data from the Shunto.
Which, for our listeners, is the big spring wage negotiations.
Exactly. They happen between February and April, and since the BOJ's entire premise rests on sustained wage growth,
The results of the Shunto are everything.
they're a direct determinant of the next move. If those talks don't deliver the wage growth they expect, that whole virtuous cycle narrative kind of falls apart.
And that's why the terminal rate projections are so gentle.
Right. Analysts project it'll settle somewhere between 1.25% and 1.75%. That implies, maybe 2 to 4 gentle hikes over the next 2 years, all depending on that wage data.
Okay, let's shift across the Pacific. Moving to the U.S., the political tightrope for the next Fed chair is, it's particularly delicate.
It really is.
Jerome Powell's term ends in May 2026, and President Trump is reportedly looking at either former Fed Governor Kevin Warsh or Kevin Hassett.
And whoever takes that job faces what multiple sources are calling a no-win scenario.
How so?
They have this near impossible task of balancing presidential demands, which are publicly for rates at 1% or even lower with the Fed's dual mandate.
Max employment, stable prices.
Right. And with an already divided FOMC, they risk either upsetting the White House or, maybe worse, risking their long-term credibility by looking too political.
But doesn't the actual economic data sort of override the political pressure here? I mean, we just saw US Q3 GDP grow at a very strong 4.3% annualized rate.
Which was much faster than the expected 3.3%.
Exactly. That kind of strength, it fuels the most hawkish arguments against easing.
It absolutely strengthens the hawkish case. Robust growth data makes it much harder for a new chair to just immediately cut rates without looking reckless. You can't justify 1% rates when the economy is growing at over 4%.
And yet, despite that strength, the market is still pricing in 2 rate cuts in 2026.
Yeah.
Why is there still such a gap between what the market wants and what the Fed itself is projecting?
That gap tells the whole story of the uncertainty. The market is betting on a soft landing and wants the Fed to react fast to any slowdown.
But the Fed's own projections.
The Fed policymakers' median projection points firmly to only 1 reduction in 2026. They are far more worried about reigniting inflation than the market is.
So the next chair inherits a huge credibility challenge from day one.
A massive one. Managing that disconnect between Wall Street and the economic reality will be their first and probably biggest test.
Let's touch on the euro area briefly. The ECB seems pretty committed to stability and hitting its 2% target, yes.
That's a guiding principle. The ECB Governing Council kept key rates unchanged in December. They're determined not to ease prematurely.
And the growth forecasts look a bit better.
They do. They were revised up for both 2025 and 2026 to 1.4% and 1.2% respectively. This resilience is coming from rising real wages finally feeding into consumption, plus the effect of the rate cuts they started back in June 2024.
And there was really specific detail I saw about 2027 inflation expectations being linked to EU climate policy.
Yes, that's a fascinating nuance. The expected inflation for 2027 was revised down slightly. Not because of traditional economics, but because the EU emissions trading system 2,
ETS2, right.
which puts a price on carbon for things like heating and transport fuels, is now expected to be postponed from 2027 to 2028.
And since that's inflationary.
Delaying it eases the 2027 forecast. It just shows you how deeply policy choices, even climate policy, are now woven directly into monetary planning.
Let's pivot now to commodities. This is where we see that great divergence phenomenon at its most stark as 2025 closed out.
It's incredible to watch.
We're seeing precious and industrial metals soaring to record heights, while energy and agriculture are, well, they're softening.
This is a metals supercycle that seems structurally different. You have gold, the classic safe haven, breaching the historic $4,500 per ounce milestone.
And that's driven by the usual suspects, geopolitical fear.
That and persistent record central bank buying. It's a loss of faith in traditional assets and global stability.
But the more telling story might be on the industrial side. Copper surging toward $12,000 a ton, silver breaking $75 an ounce. This isn't just a flight to safety.
Precisely. This is about demand for the future. This massive surge is fueled by structural demand for materials needed for AI data center infrastructure.
The wiring, the cooling systems.
All of it. And more broadly, the global energy transition, electric grids, batteries, you name it.
So how does this change the old resource playbook? Copper used to just be a barometer for China's economy.
Right, but this rally is happening despite a broader economic slowdown in China.
Which suggests a profound structural shift.
It signals that green demand and the physical needs of the digital economy are becoming the primary non-cyclical drivers. For the first time, commodity pricing is less about OPEC plus quotas and more about the structural need for digital materials. The playbook has been rewritten.
And you contrast that metal frenzy with the energy glut.
It's astounding.
Crude oil prices actually declined in late December, despite what should be massive geopolitical tailwinds.
You're talking about the U.S. seizing tankers off Venezuela, the continued closure of the Red Sea, things that would normally send prices soaring.
So why the drop?
It's the definition of a structural supply overhang. Even with all that risk, the market is simply too saturated. The oversupply is expected to persist well into 2026 unless OPEC Plus does something drastic.
And that divergence captures the moment perfectly.
It does. We are simultaneously decarbonizing, seeking vast amounts of digital materials, and unfortunately rearming.
That focus on the digital future brings us right to the global regulatory watershed for crypto and tech. 2025 was the year regulation went from, abstract policy to actual practice.
And stablecoins were the major focus area globally. Analysis shows that over 70% of jurisdictions really progressed their stablecoin regulation last year.
Which provides a tailwind for institutional adoption.
A huge tailwind. We saw financial institutions in about 80% of jurisdictions announce new digital asset initiatives, like JP Morgan, for instance, with its tokenized money market fund.
And the data suggests it's working right. The analysis that shows regulated virtual asset service providers, VASPS, have way lower rates of illicit activity.
It's crucial for building public trust. In the EU, the Markets in Crypto Assets framework, MiCA, is moving aggressively from policy into practice. They've started licensing crypto asset service providers, or CASPs.
And Germany is leading the pack.
They are, which gives the EU a big head start on regulatory clarity.
What about the U.S.? Are they catching up? The CFTC confirmed Michael Selig as chairman in December.
Selig is pushing hard. He supports legislation to give the CFTC more authority over spot markets, and he's pledged to accelerate the review process for new registrants. They're playing catch-up, but aggressively.
They launched that Crypto Sprint initiative. What came out of that?
A couple of big things. First, it led directly to listed spot crypto trading on U.S. regulated exchanges starting in early December. That's a huge step for institutional comfort.
And the second thing,
Perhaps more telling, they launched a pilot program for using tokenized collateral in derivatives markets. That's expected to go live by Q1 or Q2 of next year.
so even if it's fragmented, the U.S. is trying to legitimize the institutional side very quickly.
Exactly. The CFTC is making a very visible attempt to control that part of the market.
So let's connect that physical demand for metals back to the financial speculation that's fueling it. The AI boom is driving almost all of the excitement right now. But you have to ask, is this justified or is it trending towards, irrational exuberance?
Or maybe something darker. It's a complex question. Sources point to two interrelated bubble possibilities. One is in the aggressive behavior of the AI companies themselves.
And the other?
The other is in how investors are behaving, just pouring money in because of FOMO.
The company behavior is it's astounding. Startups raising billions without a product. Thinking Machines Lab raising $2 billion, then reportedly talking about a $50 billion valuation months later.
And Safe Superintelligence, valued at $32 billion, also without a public product. It's staggering growth based purely on potential.
It is the definition of speculative equity.
But beyond the valuations, there are some grave financial concerns about how these investments are structured. Critics are pointing to what they call circular deals.
Can you give us an example of how a circular deal works and why it's a red flag?
Sure. Think about NVIDIA and OpenAI. NVIDIA, the chip maker, announces a $100 billion investment in OpenAI.
Who is their biggest customer?
Who is their biggest customer, who then turns around and uses that money to buy NVIDIA chips. It's not really arm's length revenue, it's funding your customer to buy your product.
And there's an even more aggressive example.
The one that really alarms analysts is that OpenAI itself, while deeply unprofitable, has made $1.4 trillion in investment commitments to counterparties.
Wait, 1.4 trillion?
Trillion. And those commitments are designed to be paid out of future revenues from those very same parties.
That's the faith required to underwrite that seems unsustainable, especially when you look at the underlying debt risk.
The debt side is where the systemic risk really is. You have this unhealthy behavior where startups are borrowing massive amounts of money to build data centers for other startups.
Often using off-balance sheet vehicles like SPVs.
Right. They're using debt to finance infrastructure for highly speculative, non-guaranteed customers. This confuses speculative equity with predictable debt financing. If the AI company renting the data center fails, that supposedly low-risk debt suddenly has no repayment mechanism.
So what's the core lesson from history here? From the radio bubble or the telecom bubble?
The primary loss mechanism in those bubbles was that the technology's newness makes its impact wildly unpredictable. Radio was revolutionary, but it took decades for the real winners and the lasting business models to emerge.
And the same is true for AI.
It is. While the potential of AI is vast, maybe one of the greatest transformations of all time, the sheer number of unknowns makes it almost impossible to correctly identify the winners today, and much, much harder to justify these multi-trillion-dollar debt commitments based on uncertain future revenue.
So what does this entire remapping of the economy mean for you, the listener? We are witnessing a world driven by this structural demand for digital materials and, at the same time, highly divergent policy paths from central banks.
That's the core tension.
Japan is finally hiking, while the Fed struggles to even commit to its next move.
The world is simultaneously decarbonizing and rearming. It's creating these pockets of extreme structural value, like the metal supercycle, and at the same time, significant systemic risk in the highly speculative AI space.
Geopolitical fear drives gold, while pure technological speculation drives copper. So given the scale of debt being deployed to fuel this AI infrastructure boom, a boom that is highly speculative and lacks predictable cash flow, we have to ask you this. Will the debt and infrastructure supporting this AI revolution collapse before the technology's true winners and its definitive societal value are actually known?
That is the ultimate financial question facing the global economy in 2026.